Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Here's what we're seeing after a volatile April in the financial markets and the global economy. The S&P 500 is on pace to have one of its most volatile years in the past half-century. About once a week, the stock index is experiencing at least a 2% swing in price in a single day. If this keeps up, it will be similar to 1987, the dot-com bubble, the Great Financial Crisis, 2011, 2020, and 2022. The common factor from those years is a bear market. Despite the steep price drop to start the month, the major stock indices are closing this month at about the same level that they traded at a month ago. With economic uncertainty higher and broadly the same prices as a month ago, our cautious stance is unchanged. One sector that continues to show weakness is technology. Over the past decade, the price-to-earnings ratio for the tech sector averages trading at about a 20% premium to the PE ratio for the total stock market. That premium got very extended last year, peaking at nearly a 50% premium. We're now back around the 10-year average. That makes the valuations in tech look more fair, but if we check the buy spot prices of the 64 tech companies we follow as potential adds to our stock portfolio, another 20% downside remains before the entry point really looks attractive. That aligns with the difficult growth comparisons that many large tech companies have to report against in this year's quarterly earnings releases. Tech companies tend to underperform when revenue growth is decelerating. That's been the case to start 2025, and we expect it to continue for some time longer. While stock prices look unchanged over the past month, there are other asset classes showing persistent moves that are telling us more about what's happening in the world. The US dollar has been weakening throughout this year relative to other major currencies like the euro, pound, yen, and Swiss franc. The 2-year and 10-year US Treasury yields are falling. Commodity prices, such as the prices of oil and natural gas, are falling steadily. All of this suggests a weakening growth rate for the economy, and it makes it difficult to want to buy riskier assets when financial asset prices remain high. One asset that has performed well year to date that also adds to this case for weakening growth in the economy is gold. In fact, the gold price in US dollar terms has more than doubled over the past 2.5 years, and over the past 20 years it has performed even better than the S&P 500. We typically keep between 1 to 10% of our portfolios exposed to precious metals in all 3 of our investment strategies. We intend to always maintain some exposure to this area because it's a valuable component to have in an investment portfolio. That said, with the recent large price appreciation, we have trimmed our exposure a bit. We like the long-term case, but it would not surprise us if this area takes a breather in the intermediate term and provides another entry point to add more at lower prices in the future. Because of the headwinds facing the largest companies in the world, we think 2025 will be the start of a multi-year period where it will be difficult for a person to blindly own a market cap index and expect great results. Over decades, an equal-weighted version of the S&P 500 has outperformed the market cap version. It's hard for the biggest companies in the world to continue to outperform. However, there are 7 to 10 year long periods when the market cap version is the outperformer. That is what we've experienced in the past decade. So far in 2025, the funds that are showing discretion in how much they're willing to pay for a stock are outperforming again. We expect that to continue. And it's not as simple as just owning a list of stocks that are cheap versus the market or their own trading history. It's also how management is reinvesting in the company's future growth, how strong the business is performing currently, and how safe the company's balance sheet is in case of a poor turn in the economy. Multiple factors matter. We mentioned the opportunity for those actively selecting a portfolio, but we aren't the only ones that recognize that. Last year and this year, the number of new ETFs issued in the market has boomed. That means a lot more vendors trying to convince you that they have the golden ticket to increase your wealth in a foolproof way. Our only suggestion is just be careful. Maybe 5% of the funds like these really add value, and the rest just create noise and distraction from focusing on your investment goals. Lastly, because the stock market has rallied back to where we were a month ago, we think it's important to remember the downside that's still present from today's level. We had a nearly 19% drop in the S&P 500 from its February peak into the close on April 8th. That may be the end of this volatility for the year and we're in the clear. But if the decline is not over and we experience a recessionary bear market, the team at BCA Research forecasts a total peak to trough decline of about 30%, or what would be another 23% decline from today's price. Given the current state of trade negotiations and what's priced into the market, in our estimation, the downside risk continues to eclipse the upside opportunity. We hope that gives you a sense of what we're tracking in the market today. If you have any questions or would like to learn more about Oxbow, please contact us. We like to provide the information we think is most valuable to investors. If you'd like to see more of our insights, please subscribe to our YouTube channel.